Hi everyone, welcome to this lecture on inventory. In this lecture, we're going to cover the following: different methodologies of inventory, LIFO, FIFO, and average. So a little bit about inventory. So merchandise that is on hand, not sold, it's sitting in a warehouse somewhere, is the line item that you see on the balance sheet labeled inventory. As you sell your inventory, that eventually becomes cost of goods sold, which is on the income statement. And materials inventory is the costs of raw materials that are used in manufacturing a product. Work in progress inventory are costs for partially completed product, and finished goods inventory are costs for a completed product. So there are different stages of inventory. So in this example, materials inventory, if you wanted to make, a candy bar, your materials would be cocoa and sugar. And the work in progress inventory would be the costs that have been put into the production, as well as labor and overhead costs. So these are the people that are taking the cocoa and sugar and creating those candy bars. And your overhead costs are fixed costs such as electricity, equipment, and heating. The finished good inventory is what you will be selling, and those would be the candy bars. So once those finished goods are sold, if they're sitting in your inventory and then you sell them, the costs for that are then transferred to the cost of goods sold on the income statement. Because if you recall, cost of goods sold or costs of revenue are the costs that it takes to produce the products that you sell. So here's a quick depiction showing you all of the phases that inventory goes through. So you start with your materials of the cocoa and the sugar, and then there's that work in progress. And these are the people that are putting the cocoa and the sugar together to make those candy bars. And then you have your finished goods, which is a chocolate bar. And as all of those, you're incurring all of those costs. Once you sell that chocolate, it then appears on the income statement as cost of goods sold. So for inventory, when a unit is sold and it's identified with a specific purchase, there are no assumptions that have to be made. And this is a specific identification inventory cost flow method. And that's not practical for many industries. When identical units of inventory are acquired at different unit costs during a period, that's when a company has to determine, are they going to use FIFO, LIFO, or the average cost methodology. So FIFO is first in, first out. So the cost flows are in the order in which the costs are incurred. LIFO is known as last in, first out, and the cost flow is in the reverse order in which the costs were incurred. So with LIFO, last in, the last items you purchased for your inventory are the first ones that you are going to sell. And a company can go back and forth with FIFO, LIFO, and average. However, when it comes time for a company to file their financial statements, one has to be selected. And if a company is going to change, they have to give substantial evidence as to why they are changing their methodology. So first, we're going to talk about FIFO, which is first in, first out. And FIFO is typically used in the perishable goods industry and the designer clothing industry, right? So for example, if I sell seafood, the first seafood that I buy, I want to make sure that that's the first that I sell. And in designer clothing, the same would hold true, because if I purchased inventory later on, that already may be out of style. So it may make it more difficult for me to sell the last items that I've purchased. So again, FIFO is the inventory that you purchase first. and it gets sold first. And when the item is sold, it's necessary to determine its cost using a cost flow assumption and related inventory cost flow method. So I'm going to give you an example. We're selling candy bars, and the assumption is that our candy bars are being sold at $1.50 each. So what do I need to know? So in this one particular month, I sold 200 candy bars. But before I sold those candy bars, I've been purchasing the things that are required for these candy bars. Or let's say I purchased a whole candy bar and now I'm going to sell them for $1.50 each. But through the months, I've been making purchases, right? So on January 1st of whatever year, I buy 100 units of these candy bars. And the vendor that I was working with was charging me 50 cents. So the total cost for that inventory to sit in my inventory is $50. It's the 100 times the 50 cents. And then on the 15th, I say, okay, I want to purchase some more inventory and I want to purchase 150 units this time, but my vendor has increased their prices and now I have to pay 75 cents. So my cost is $113 for that inventory. And then on the 1st of February, I want to have another 200 candy bars in my inventory, and my vendor has yet again increased its prices, and now my inventory is 160. So that's a total of $323 that sits on the balance sheet under inventory. And then as I sell these candy bars, depending on FIFO, LIFO, or the average cost method, that money, those amounts under total cost will move out of inventory and they will move onto the income statement under cost of revenues or cost of goods sold. So using FIFO, I sold 200 candy bars. In the FIFO methodology, I start at the top. I start at my first purchase. Right? That was the first in. That's the first purchases that I made. And I purchased 100 units at 50 cents. So my cost is $50. That $50 down here is going to move over to cost of goods sold or cost of revenues. But remember, I sold 200 candy bars, which means I have to take 100 candy bars from the purchase that I made on the 15th of the month at 75 cents. And coming down here, I look at the 115 purchase, 100 units at 75 cents, that's $75. So that means I've sold 200 candy bars and my cost of revenue or my cost of goods sold based on the FIFO method was $125. So now what happens with the balance sheet inventory number, right? That number from 323 that we originally started with is going to drop down because we've sold 200 of these. And what's going to remain on the balance sheet, remember from the 15th purchase, we used 100 of these. So 50 drop down here and remain on the balance sheet, and they're valued at 75 cents each, which is $38. And then my entire 200 purchases from February 1st at 80 cents was not touched because this is FIFO, first in, first out. So that remains on the balance sheet. 200 candy bars at 80 cents, that's $160. So $198 remains on the balance sheet, whereas 125 was moved over to cost of goods sold. So this is taking a very quick look at the gross profit using the FIFO methodology. So I sold 200 units at $1.50. My revenue is $300. My cost of goods sold for those 200 units using the FIFO method was $125, and my gross profit is $175. So to recap, the beginning inventory in totality was 450 units, and I purchased those 450 units at different prices depending on the day that I purchased them. My total inventory was valued at 323. Then when I sold the 200 candy bars at $1.50 each, that brought me in $300 of revenue. So using up the inventory from the purchase on the 1st and the purchase of the 15th, that was $125. So my ending inventory would be 450 units, which is what we started with, minus the 200 units that were sold. And it means I have 250 units sitting on my balance sheet under inventory. And the value of that is the $323 for the 450 units that we originally purchased with 3 purchases, minus the $125 that I'm moving over to cost of goods sold. So now I have $198 sitting on my balance sheet under inventory and $175 in gross profit. With LIFO, it's the complete opposite. So with LIFO, I take the last purchase and I sell that first. So the purchases that I made on February, that was the last purchase I made, those are going to be the first to move out of my inventory. If I sold 200 candy bars, I purchased 200 candy bars on the February 1st purchase at 80 cents for $160. So what's going to happen to the cost of goods sold on the income statement, and what will be my ending inventory on the balance sheet? So for 200 candy bars, it cost me 80 cents from February 1st at $160. I don't need to use any of this other inventory because 200 is the number that was sold. So $160 moves over to the cost of goods sold on the income statement. And then what remains on my balance sheet is the inventory that I have not touched, the inventory that I haven't sold. And in the LIFO situation, I haven't touched any of the purchases that were made on January 1st and the 15th. So these amounts remain on my balance sheet. So under the LIFO section, I sold 200 units. My revenue is $300 because my candy bars are being sold at $1.50 each. And using the LIFO method, my cost of goods sold is $160 because I purchased those candy bars at 80 cents a piece, and my gross profit is $140. Using the average cost methodology, here we see our original purchases, and I take the value of my total purchases and I divide that by my total number of units, and that gives me an average of 72 cents. So again, in this situation, what would be the cost of goods sold on the income statement, and what would be my ending inventory on the balance sheet? So I'm going to take my 323, I'm going to divide that by the 450, which is the total number of units that I've purchased. 72 cents is my average cost. And it's going to leave me with $179 that sits on the balance sheet. If you look down here at the bottom, I sold 200, which means I have 250 candy bars left over. And everything is going to be using that average cost of 72 cents. So the sold of 200 times 72 cents is 143. That goes on to the income statement as cost of goods sold. And 179 will stay on my balance sheet under inventory. So let's just look at a quick comparison of using the different inventory methodologies. In FIFO, our beginning inventory, well, in FIFO, LIFO, and the average, our beginning inventory in every scenario was $323. Under FIFO, I sold 200 candy bars at $1.50 each, and my cost of goods sold was $125, and my ending inventory was $198. Using the LIFO method, my cost of goods sold was $160 because I used the more expensive inventory because it was the last purchase that I made, and typically prices increase as time goes on. And my ending inventory was $163. And with the average, using that 72 cents, my cost of goods sold was $143, and the ending inventory was $179. So for FIFO, my COGS, my cost of goods sold was $125. I have $198 left in my inventory, and my cost of goods sold is lower, which means my profits are higher. So if I have revenue of $1,000 and my cost of goods sold is $100, that's a $900 profit, and I have to pay taxes on that $900. Under LIFO, that same $1,000 in revenue minus, let's say, cost of goods sold of $500. Now I only have gross income of $500, and then my taxes will be lower. And using the average inventory method, it's somewhere in the middle. So here's a very quick income statement, if you will, highlighting each of the gross profits using each method. Under LIFO, my gross profit was $140. My FIFO method was $175 and $157 on the average methodology. So here's what we learned in this lecture. There are 3 inventory methods that a company can use: FIFO, LIFO, and the average cost method. A company can change the methodology that they're using, but they have to give substantive information as to why. In LIFO, when you're selling a product, the last inventory batch that you purchased is used first. And that's always assuming that the costs are always rising with LIFO. In FIFO, when you're selling your products, the first inventory batch that you purchased is sold first, and it's typically used in the perishables inventory. With the average cost method, when you're selling a product, all inventory purchases are averaged out.